Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and this morning we are running through the Australian property market update for October 2024. Lots happening within the month, so stay tuned and I'll give you a update and a forecast of where I believe we're heading in the years to come. But to kick it off, the index results out of CoreLogic to October. We continue to see strong run from Perth, Adelaide, and Brisbane, with Perth leading the charge 1.4% up for the month, followed by Adelaide 1.1% for the month, and Brisbane 0.7, trailed by Sydney, Melbourne down, subdued for the month, Sydney 0.1% and Melbourne 0.2% negative for the month. And if we look at the annual return to date, or even total return to date, we can see Sydney is up to date for the year, or annual for the year, 3.7%. Melbourne down for the year to October, 1.9%. Brisbane up 13%. Adelaide 15%. Perth 22%. So strong run this year from the smaller metros, being Brisbane, Adelaide, and Perth. That's not necessarily meaning that's where we're buying. We're focusing now and for the next probably 5 or 6 years in Sydney and Melbourne in preparation for the next upturn, but I'll get to that in future slides. So we are very excited, especially on Melbourne at the moment, getting great deals down there, and I think it's coming to more or less an end and bottoming out. As you can see in the median values too for Melbourne, Melbourne is actually the fifth in median values. So very affordable. Typically, it's one behind Sydney, but it's because the strong run plus the subdued growth in Melbourne, or strong run from Brisbane, Perth, Adelaide in recent years, and subdued growth from Melbourne. Melbourne has dropped into fifth place in terms of the median value. So to me, that is cracking opportunity right now. Yes, it may be daunting to try and buy something in Melbourne, as most people look in the rearview mirror. And if you look in the rearview mirror for Melbourne, uh, it's been pretty much flat to negative over the last few years. So we're picking up deals now in Melbourne for the same, if not less, than what people bought them for dating back to 2015 and 2016. So there's the update for where we are at for October, and where we're seeing great value is in Sydney and Melbourne, and drawing equity or adding value to our existing stock or properties within the Brisbane and Queensland regions. Personally, that's what I'm doing. And for clients, that's what I'm advising. If you've got property across Brisbane, Perth, Adelaide, great time to add value by renovation, addition, development, but not necessarily keep buying in those markets, because it's getting to a point now where it's getting too hot to acquire. You want to buy in the more suppressed and soft markets before they go through the significant bull runs. So bit more of a deeper dive and look under the hood for the month. As you can see, again, Brisbane, Perth, Adelaide have had a good strong run, and the regions too, their respective regions. So WA, South Australia, Queensland, New South Wales to a lesser extent. And what I find interesting too is looking at the past 12 months. So for past 12 months, Perth has outperformed 22%, Adelaide 15, and Brisbane 13%. Melbourne down 1.9 and Sydney only 3.7%. So we're seeing the good value, as said before, but also the regions, Victoria and New South Wales regions, have underperformed last year in comparison to Queensland, South Australia, and WA regions, which is quite typical to see at this time of the cycle as people decentralize from the larger metros and move to the more affordable markets. That's when they have their good run. So that is showing how, if you can see the 18-year land cycle within this data, how you can see the smaller metros and their respective regions outperforming in the last couple of years, where Sydney, Melbourne, and regional New South Wales and regional Victoria has been more subdued. Auction clearance rates. So as we've coming through spring, a lot of people put their properties on the market to sell as they believe it's a better time to sell with staging, lighting presents the property better. Ironically, because a lot of people do that, that increases the amount of stock on the market in terms of sales listings. Therefore, there's more options for people to buy, and ultimately less properties sell. So that's been now reflected consistently for the last couple of weeks in the auction clearance rates. So these are the percentage of properties that actually sell come Saturday and what are passed in. So when the auction clearance rates are above 70%, that's a booming market. When they're below 70% or below, like between 50 to 60, that's more of a stable market. And then below 50, that's a pretty soft market. So, but these auction clearance rates can change within 2 to 3 months. So it's a good indicator to understand where the actual market sits within the next few months. I specifically like buying between now and January because one, you have more stock coming to market from people listing from spring. There's then a flow-on effect where stock is left over from spring because there's not as much people to buy. People, and as we come into November and December, people are then thinking about going on holidays, Christmas parties, not necessarily making such a large commitment coming into the Christmas rush. And also in January, there's a drop in demand from buyers. So that's where you see a, a leftover amount of higher stock, a lesser demand from buyers. This is now being reflected in the clearance rates, creating a more soft market for this period between typically October to January is a great time to buy. And then to sell, where most people think it's a bad time to sell in winter, therefore a lot of people hold back from their property from selling in winter. So in say June, July, August is a great time to sell because there's less stock on the market, less people looking to sell. So then you sell in isolation and then it drives prices up. So classic supply and demand equation. So right now we're seeing great opportunities, specifically in Sydney and Melbourne for the long term, um, but then also the rest of the, I guess, regions. But we're not advising going to the rest of the regions such as Brisbane, Perth, Adelaide because they've had such a strong run the last few years. They're more so coming to the top of their growth cycle. We like to get in before the growth cycle. So that is Sydney and Melbourne right now. And as you can see, it is soft clearance rates, so cracking time to get in. If these were all, I guess, above that 78, 80% mark, that is when it's probably time to just cool off, catch your breath, wait a bit until there's a flow on of more stock coming to market, more subdued, then the sales are out there. It's like Maya trying to flick all their winter clothes now coming into summer, all their jackets, suits, pants, all on sale. They're just trying to get rid of all the stock because they've got too much stock. They're trying to just get rid of it, so they drop their prices. There's less demand. There's less people looking to buy suits and jackets now coming into summer. So that's when you can get a good deal. Same concept with property. So there's short-term data we use to work out where each market's performing in the short term, but then also long-term, it's 20 years of sales data where we link it to the 18-year land cycle to work out which metro and or region to focus on. So that is the clearance rates for the month. Rents are still going strong. They have softened. I mean, personally, I've felt feeling rents softening more so in New South Wales. Queensland is still going strong. Rents are continue to rise. There's literally just a lack of stock. Um, but I mean, to September, rents are still compounding at 6.7%, which is above average. Typically, it's between 2 to 3%. So this is reflected in the lack of rental accommodation. So I've got property, well, three in up in a couple of towns out in a specific town out in Queensland, and recently I've had a tenant move out, put it to market to lease, and this town has only 15 or 16,000 population, and only ever has two or three rentals or available uh, rental properties available at one time. So that's what's driving rents, the sheer lack of rental accommodation. Where there's a lack of rental accommodation, you can push rents and to really as high as you want. So that's been reflected in this data over the last few years, and it won't be until more stock comes on from more construction, more building that adds to the rental stock that will then subdue and slow down this rising rental inflation. So, I mean, the government's stepping in recently to try and put restrictions on how many times you can raise rents, um, making it restrictive on how many times you can inspect your rental property, how many times, sorry, if you can have pets, if the tenants can have pets, if or reasons to evict tenants, you can't just evict for no reason. So the government's swaying the legislation towards more so towards the tenants. This will ultimately get baked into higher rents anyway. It's quite counterproductive. Ultimately, if you're going to push rents more onto landlords and investors, though that higher risk will ultimately get priced into higher rents. So that restriction, that higher risk, will actually be counterproductive and continue to drive rental growth, I believe, because less people will be looking to invest in property and moving their money elsewhere, such as putting in the stock market, in crypto, and in bonds to get a more stable return. Because if they're thinking, well, now that it's the legislation is now more favorable towards the tenant and that's more higher risk, um, that's going to reduce the amount of rental stock, which is ultimately going to the demand's never going away, and there's always a high demand with all this population coming in, where there's a less demand or less supply of rental accommodation, and the demand's there and continues to grow, rents will continue to rise. And as these rents rise, the rents then get capitalized into a higher price, and then the market continues to move on. So you never typically find, I guess, residential real estate we can find yields up to 8, 9%, but typically you don't find them between 10, 11, 12, 13%, especially in the metros. In the regions, sometimes you can, but that's because the prices then follow. The rents rise, the yields become attractive, that draws investors or investment, then the prices then increase to compress those yields again. So when rents rise, it's a good leading indicator that prices are soon to follow within a few years, a year or two. CPI, so inflation is down to 2.8% as of September. It's down 1% so in June it was at 3.8, so now it's down another percent within this quarter. Good news. But I mean, the RBA is saying that they want to see the inflation rate held within the 2 to 3% band consistently for at least 6 to 12 months. So as you can see historically, within the 2 to 3 band would be similar to what happened in 2014 to 2019, where it's consistently held within the band of 2 to 3%. I mean, we've just scraped in, so I wouldn't be getting too excited yet in terms of interest rates dropping. And they're saying not until 2026 is when they predict that inflation will be sustainably within the band. So I say hold tight. I don't expect rates to drop potentially maybe next year, but it sounds like they won't be coming down until 2026. So, but it's positive news on the horizon. We are at least within the band. It just needs to be consistently held within the band to give the RBA confidence that it's not going to spike and inflation is not going to kick off again. But good times ahead, and we can see the light at the end of the tunnel. So the RBA on Tuesday again held the cash rate at 4.35%. And as I said before, the inflation is down to 2.8, but they want to see it within that 2 to 3% band within a consistent period of time before they drop the rate. So it won't be until probably, I'd say, mid to late 2026, where I can see the cash rate coming down again, which is then overlaid by the 18-year land cycle as the cycle will top out in 2026. In April 2026 in the States, Australia will trail 6 to 12 months behind. Come end of 2026, it'll be clear that the market's topped out and potentially even on the way down. Come 27, rates will be coming back to near zero again before you know it, based off history. But time will tell. Another good indicator for the next few years is Australian investment lending is on the run again. As you can see, it's now hitting all-time highs. Happy days. This is credit. People are drawing more credit. They're putting it into the market. Ultimately, the market is priced based off how much people can pay for property. So if they can borrow more credit and there is more investment credit going into the market, that's going to push prices and push the market on to the next level. So as you may recall, the big boom we had post-COVID, 21, 22, that was a big credit expansion. The one before that, 2016, 17, we had a good run, and lead up to 2015, just to give you the last, I guess, 10 years. But if you scale this back, pre-GFC, it has another good expansionary period in investment credit. So when credit starts to run, that's also another good leading indicator that prices are going to run in the next couple of years. Population. So Albo continues to run the biggest net migration program in history to March 2024. So between 2022 and 2023, we had 700,000 migrants come into the country. This is what's basically soaking up all rental accommodation and putting a lot of strain on the housing market. With more people coming in and the construction not keeping up with the demand, all the rental and housing stock gets soaked up, and there's less available rental and home owner occupier properties to live in. So between 2022 and 2023, there was 700,000 people came in, about 300,000 or 350,000 each year. Historically, it's between 150 to 200,000, so record numbers. In 2024, or from up to March 2024, so 1 year alone, 600,000 people have come into the country, so 2.3%. So that is nearly three times the historical amount, which is good for property investors. It's going to continue to soak up rental accommodation, drive rents, put more pressure on housing demand, continue to push demand for housing. That's going to continue to drive rents higher. Those rents will get capitalized in high prices, and prices are going to continue to keep outperforming in the years ahead. So out of all these migrants, 60% is going between Sydney and Melbourne. So roughly 30% are landing in Sydney, 30% are landing in Melbourne. So 60% of all these migrants over the last few years are landing in these two metro markets, and the rest is getting scattered across the regions and the smaller metros. So again, another great example of how we are getting very excited on Sydney and Melbourne. One, because they've had subdued growth the last few years of 10 years of subdued growth, or 8 to 9 years of subdued growth. So they're primed for the next growth cycle based off the 20 years of sales data, but also they're getting most of the population growth. So that's going to put extra pressure on those markets, priming them for their next growth cycle. Australian construction sector has stalled. So costs of up to 700,000 to build a unit now, specifically in Sydney. So, and probably the other metros to a lesser amount, because I guess labor costs are cheaper in the smaller metros compared to Sydney. So, but anywhere between 600 to 700,000 per year for a unit to build. So once, if the builders or the developers build that stock for 700,000, it only stacks up in the premium suburbs, so eastern suburbs or Lower North Shore, even not so much even the inner west. So come the inner west and western suburbs, we're picking up units in Sydney for sub 350. We're picking up units in Melbourne for sub 300. So we're picking up units for half the intrinsic value what it costs to build. This is the reason why there's a lot of developers that have approvals by council. They've got all these land, but they're not going to start building until the market moves at least 30 to 40% to make the jobs stack up and be profitable, because they're not just going to start building rental property, start building units and housing when there's no profit in those jobs. So this is another good sign for investors to get confidence on that the market is very primed for growth, specifically in Melbourne and Sydney, where we're finding these deals for half the intrinsic value of what it costs to stack up. And it's not going to be until a couple of years until the market really moves before we get more stock from the private sector. Government's doing their best to try and try and build 1.2 million homes, but I mean that's very ambitious number, more politics than anything. It's probably not achievable, to be honest, within that 5-year period. Harry Triguboff, the biggest developer in Australia, struggles to build a couple of thousand units a year. So if a private developer can't even do it, I don't think the government will become anywhere near those target numbers. So that's quite interesting. The amount of growth that needs to be had in order to allow developers to have profitable jobs to then make these projects stack up is still a little way away. Put this link in here to so permits. Actually, yeah. So Australian building permits. We look at the history; they are still at low levels. So based off data, so compared to, I guess, the big boom we saw in 2021 and 2017, we had a big boom where a lot of approvals are going through. So we're at pretty historic low levels based off history. Again, in 20 or post the GFC, we had a spike in approvals. The big lead up in prior to the GFC, we had a good run with approvals, and before the dot-com busts, so up 1998, 1999, good run of approvals, and then went through dot-com bust down, and then in the mid 90s had a good run, and this is 1987, 1988. This is a typical run where is in the second half of the land cycle, where the big boom prior to the 91 recession, where we had a strong run of approvals and then a slowdown. So we are at the bottom end, and it's only probably 2 or 3 years away. Once the market moves 20 or 30%, it'll make a lot of jobs then stack up and be profitable, and then every man and his dog will be building like crazy. It'll be the big construction boom again, like what we saw in 2017, 2015, 2016, 2017, where we had a big construction boom. There's a lot of stock being added to the market in the next few years. Will come to market, I believe, in the next few years once the values stack up. And then once every developer is building like crazy, then it doesn't take much for the equilibrium to shift from being an undersupplied market to an oversupplied market. And then that will inevitably turn the market through its next land-driven downturn. So typically we see a slowdown, or the GFC, the 91 recession, 1972, 1955, 1933, these historic land-driven downturns come after a couple of years of extreme prosperity and exuberance and speculation in the market. And we're not seeing that right now. So I believe in the next 2 or 3 years, we're going to see a big property boom, big construction boom. It's all going to take off. It's going to suck a lot of people in. A lot of speculation will come at that point. Once everyone thinks it will keep going on forever, that is the most dangerous point in the cycle, where it'll turn and we'll go through the next land-driven downturn. So we are still a couple of years away from that. And it won't be until these approvals start to rise, once the values stack up, which is when it's a good leading indicator that we could be coming to an end of the current cycle. So again, what's restricting on the construction sector is, I guess, government intervention. Government organisations continue to be a bottleneck. I mean, Sydney Water, they can't keep up with the growth. Developers are looking to build, build more subdivisions, high-rise apartments, and Sydney Water just can't keep up with the water and sewage infrastructure. They just don't have the capacity. So that's holding developers back as well. On top of, I guess, cost of labor, materials, and jobs not stacking up, it's getting um, the the fundamental infrastructure from Sydney Water. Endeavour Energy, they're not doing the industry any favors either. Their employees are striking. They want 25% increase. Developers are finishing products, being a high-rise apartment building or new subdivision, and then they need to get Endeavour Energy to come out and commission their substations. And Endeavour Energy are basically calling up and saying, "Sorry, we're on strike. We're not coming out to commission your projects. Call us back up in another 6 or 8 months. Book another time." 6 or 8 months goes by, they do the same thing. And it's just delaying commissioning these projects and releasing the stock to the market. So Endeavour Energy is doing another great job on restricting supply, and councils as well. Councils are reluctant to go high rise. They don't want it in their backyard. Uh, I mean, personally, I'm having uh, troubles trying to get developments off the ground. I've got probably about 4 places that stack up in Queensland where I could subdivide or even knock down and build 3 townhouses or villa style units. And they're all being restricted by new legislation that has come in the last couple of years where they've updated their modeling with regards to flood mapping. So historically, the last couple of years where we've had these floods in 2011 and in 2022, they've updated their modeling and saying, okay, these are all these new areas where you can't develop. Um, so this is another restriction from councils. And even though where there's some of these sites that I've got there around the corner, there's already a precedence been set where there's already a development of higher density being built. They were built before these new legislations were brought in. So the councils are now restricting supply because they're bringing in new legislations in relation to flooding, especially around Queensland. So when there's all these layers of restriction on the construction sector, it is literally getting to the stage where it's stalled. And when there's a stalled construction sector and there's not enough stock coming to market to meet the demand, prices are going to continue to keep rising. Trump is back. So get ready for tax cuts. So the US leads the global economy. They lead the land cycle. This is why we keep a big focus on the US economy. They have one of the biggest housing markets in the world as well. And the US land market leads the 18-year land cycle is led by the US, and then it has a flow-on effect to Australia, the UK, even now parts of China are now connecting into this global land cycle. So property tycoon coming in towards the final years of the 14 years of expansion. What do you think is going to happen? He's saying he's cutting taxes, no tax on tips, no tax on overtime. That's more disposable income. That's more money that people can go to borrow to buy property. He's a property guy. His key policies, his vested interest in property is to ultimately pump the markets, property market, stock market, crypto, everything. You watch the next 2 years is going to be like the roaring 20s. Everyone's going to be talking up investing because he's now driving his agendas, putting confidence back into the market. If you look at crypto yesterday, crypto was up 10 grand in a day. The ASX, S&P 500, Dow Jones, they're all hitting all-time highs. It is going to be the like the roaring 20s, big euphoria. speculation the next 2 years, this is a time when it becomes more critical, most critical to be cautious with your investments and not get carried away with the herd. So cutting taxes, he's going to drill oil, drill baby drill. I mean, um, if they're not drilling it themselves, they're going to be buying it from the Middle East. So he's going to be drilling them himself to bring down oil price, get ready for potentially petrol prices, diesel prices to get back to $1.20, $1.30 a litre in Australia when he's flooding the market with oil. So he's making it less, more supply of oil that will bring down prices. That'll ultimately bring down prices of transport, which will bring down prices of every goods and material supply in Australia, and we'll import that lower inflation in terms of energy costs and the knock-on effect of cost to food, materials, products, everything will come down. It's all driven by energy, so that's exciting. Ultimately, that will then allow him to cut the federal funds rates. Australia will then follow suit, typically 6 to 12 months behind the US. So he'll be most likely trying to cut rates all of next year when he comes in January. Cut regulations so allow businesses to crack on with their business and cut the red tape. And he's pro crypto. So as you can see, this is all going to feed on itself and drive the markets to the next level right at the final stages of this expansionary period. And it's going to be like nothing you have ever seen before, I believe. It's going to be the biggest boom in history. So talking to people around the 18-year land cycle, I had key questions around whether Trump would push the cycle further and elongate the cycle, but apparently not. Talking to some people in the industry who studied the 18-year land cycle, Trump is going to push the market higher. So he'll create a bigger boom followed by a bigger bust. So it's going to be quite interesting how he navigates this 18-year land cycle because we're on track and the next 2 years is going to be off the charts. We're now in the winner's curse. Every man and his dog is going to be talking up investing. Come next year, it's going to be like the roaring 20s. However, Trump is going to be having to deal with the market topping out and going through the land-driven downturn because he's in for the next 4 years. So it'll be quite interesting how he deals with the market turning and plays it. But I can tell you the next 2 years it's going to be off the charts. And come early 2026, he'll be stand up in front of everyone and tell everyone how good he is and how he's created the best economy in the world and he's the best president in the world and he's created he's brought back America. That'll mark the peak of the cycle in the early 2026. And then it will be followed by the biggest land-driven downturn in history, which I'm sure he'll just drop interest rates to near zero, if not negative, print a lot of money to kick the can down the road to prop up the economy, and ultimately all that money creation will get soaked up in asset values such as property. So good times ahead. It's going to be a roller coaster ride. It's going to be very emotional times too. As we come through the final stages, there is a tendency of a wealth divide between people who own property or who own assets because they do very well. Everyone will do very well who own assets and own especially property over the next 2 years, or and further on. But those who don't will continue to the wealth gap will continue to be further and further apart. And I think if you look at Ray Dalio's work and listen to his explanation of the economy, it's quite interesting when you overlay his commentary on the 18-year land cycle. There's a big wealth divide that's underway right now. Hence why you saw polar opposites in the United States for the election. And now that Trump's in, he's going to inflame that and exacerbate that and push the markets to the next level. And there's going to be potentially internal conflict, and a bit of a divide between the haves and the have-nots. So that's expected, and that's typical at this time of the cycle. It's not just a coincidence that there's polar opposites in politics these days than it was during the recovery when it's more of a stable market and prices are close together. Now, as we finally go through the final stage, it's going to be exuberant and good times ahead for people who hold assets such as property. So we are, I guess, to get dig down in more detail, we are no longer focusing on Brisbane, Perth, Adelaide. Um, I personally have got, half a dozen sites in Queensland and in around Brisbane. I guess my plans are to develop what I can and then come, the peak 26, 27, even Brisbane and Perth continue to outperform based off 20s of sales data throughout the downturn. So I think will, um, Brisbane and Perth may keep performing into 27, 28. Adelaide is more or less hit the peak. And then once we go through this downturn, Sydney and Melbourne will then lead again. So from 28 onwards, Sydney and Melbourne are going to kick into their next growth cycle. Hence why we're sowing our seeds now in Sydney and Melbourne in preparation for their next growth cycle, which I believe will commence around 2028 and onwards. Like the strong run Sydney and Melbourne had between 2010 lead up into 2019 in certain pockets in certain types of assets. So not going and buying new and off the plan, all that stuff, because you'll get caught out. That new and off the plan, a lot of developers will start building that now in Brisbane, Perth, Adelaide because it stacks up. But if you're buying new and off the plan, you're buying a premium product at the peak of a market when it only just stacks up. And then once the market turns, you'll be holding it for 10 years flat, if not 15 years flat until the next growth cycle where it will go up again. So that's why we stick to established property and buy in markets that have been subdued for a good 7, 8, 9 years. Because once they hit that sort of 10-year period of flat, it's any time now where they're going to kick into the next growth cycle. And we're finding we're buying property for less than what people paid in 2015. So that's 10 years of a property of going nowhere. So it was the same thing I was doing in Brisbane. I was buying up in Brisbane, 2018, 2019, 2020 for cheaper than what people bought the properties for in 2012, 2013, because they bought at the peak of the previous cycle. So we like to buy counter-cyclically to get prepared for the next growth cycle and not get sucked into the herd and the mainstream that continue to keep buying up in Brisbane, Perth, Adelaide, because those that do will probably get found out and struggle to either one, hold on to it, or they'll be holding on to it for a long period of time in negative equity once the market turns. So this framework I use to overlay on the metros, but then also the regions. The regions are also a little bit more tricky. They don't quite correlate exactly with the metros, but they do still go through periods of flat growth and then periods of uh, very strong growth. So we keep an eye on them. But as I see where we're looking in the next decade, Sydney, Melbourne, and then we'll probably be looking then into the regions in say 5 years. And then in 10 years' time, we'll be back to Brisbane, Perth, Adelaide again prior to their next growth cycle once they've had a good protracted period of flat growth. So that's the years ahead. Get ready for the roller coaster. And I guess a little bit more dig dive. This is where I see the individual markets now. I see Melbourne coming to pretty much the bottom in the next year or two. Sydney's been up and down in certain pockets, but I think Sydney's trailing a little bit behind Melbourne now based off sales data. New South Wales has topped out and starting to cool. Victoria has cooled, probably has topped out and is now cooling for probably 2 or 3 years now. Adelaide is more or less coming to the peak. Maybe you got another 10% growth. Brisbane's probably got another 40% growth before it hits the top of the market. WA, same 40%, 40% before it tops out. But then it'll go through another period of flat growth. So we like to buy between negative media and rising rents, where everyone talks down on a market where it's been flat for a long period of time because they've been looking back in the rearview mirror and it hasn't moved, and ultimately try and get in before rents start to rise. Because once rents start to rise, then those rents get capitalized on a high price because it draws on investment, it becomes mainstream, then prices rise, and then it becomes FOMO, FOMO again, and then it's off to the races. So get in before the herd. Um, I guess it can be scary to do so because you're getting into a market that hasn't moved for a while, but that is the opportunity. If it hasn't gone down any further in the last 8, 9 years, it can't go any further down than where it is. And if you're buying property for half the intrinsic value, being half the cost to replace that asset, if you were to build the same asset again in the current market, you're reducing your downside risk, and it's really only all upside. It's just a matter of time of when it'll switch into its next growth cycle. So that's why we're getting very excited and really only focusing on certain pockets in Sydney and Melbourne for the next coming years. I guess a little bit of housekeeping. This content is just general in nature. This is my thoughts. This is my story, my plans, what I'm doing personally, and what I'm doing to help my clients. This is by no means financial advice. This is not any advice or general advice. This is just general content I like to put out there. As I am not a financial advisor, you need to go and get your own advice, do your own research, get your own independent financial tax legal advice before you're making any investment decisions. I operate as a buyer's agent. If this information resonates with you, hit me up, send me an email, send me some feedback, do whatever you got to do. Happy to help you run reports of what properties you've got and where they potentially may be going, what you may want to do, run your plans of your future plans, how you wish to navigate the next coming years. Happy to help. Send me an email, shoot me a message, leave me a comment, subscribe, comment, like, dislike, whatever you need to do. Send it to someone who you think will see your value. Until next time, happy house hunting. Catch you then.